G'day, welcome to the Constant Investors Facebook live stream. It's great to see you. So I've just come from doing the property couch with Ben Kingsley and Bryce Holloway. Anyway, with Empower Wealth, they've got this property advisory service, and they do this weekly podcast, which goes for an hour. Anyway, it's called the Property Couch, and I was off there in North Melbourne doing it with them, and that was a bit of fun. They talked a lot about my own history, which I found a bit uncomfortable. I'd much rather ask questions than answer them, to be honest. But anyway, I'm not sure when that's coming up, but I'll put a link to it, perhaps on Facebook and in the overview on Saturday, because I think it goes up this afternoon on their website and in iTunes. It's got quite a lot of following. That's why I did it, of course, to plug the Constant Investor to their to all their followers and listeners. And the other thing is, hey Greg, when does the Mobilicom interview go up? Is that today?
That will go up Friday evening.
Right. So it was interesting. I interviewed this guy named Oren El-Kayam, who runs a business in Tel Aviv called Mobilicom, right? So it's an Israeli company. It's all about communications. It's quite complicated technically. I got into it in detail in the interview. But anyway, interesting business. But it's ASX listed Israeli company, and he told me there, I didn't really understand this, there are now 16 Israeli companies listed on the ASX. So I rang up the ASX just now. I just got off the phone from them, talking about what's going on, and they have been wearing a path to Israel, recruiting companies in Israel to list on the ASX, and they're going again next month with a delegation from the ASX, plus lawyers and investment bankers to try and recruit Israeli companies to list on the ASX, which is very interesting, I reckon. And they've got a lot of other companies. I interviewed a company, a New Zealand company the other day, also listed on the ASX, called CropLogic, which is a agronomy technology business. So I'll publish the list of, if you're interested, the list of Israeli companies that are listed on the ASX on Saturday in the overview, and I'll talk a little about what they're doing, but what they're trying to do, just in brief, is to provide an alternative to to Nasdaq, because the minimum size of a company on Nasdaq is about $500 million. So what these guys are going for is companies that are from about 20 or 50 million up to 200 million in size, and there's really no other place for small companies like these to list and get access to capital apart from the ASX. So they're becoming some kind of global Nasdaq stock exchange, which I think is great for us as investors in Australia, because we get to invest in these businesses in Australian dollars. So we don't have to buy Israeli shekels to invest in the 16 ASX listed Israeli companies. We can do it in Australian dollars. I think it's great. So that'll be in the overview on Saturday, a bit about that. Remember, this live stream today is general advice, may not be appropriate for you. And we'll get straight into the questions, of which there are quite a few. Thank you. Now, Gavin says, when are you able to sell shares and still receive the dividend? Have read conflicting stories. 1, only after the ex-dividend date. 2, only after the payment date. It's after the ex-dividend date, Gavin. That's the ex-dividend date is when they tally up the company, the shareholders who are due to receive the dividend, and it gets paid to the shareholders on that date. And if you sell after that date, you'll get the dividend. And if you buy after that date, you won't. John says, I know ETFs are a bit of a no-go zone at the Constant Investor. That's true, sort of. I've been banging on about that. But I couldn't help noticing a product by ETF Securities that goes under Robo Invest in global robotics and AI, which is a constant investor area of interest, of course. Do you think you might have time to have a quick look at it? So I did have a quick look at it, John, and I think it's a ripper, to be honest. So I had a look at it. It's got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 20 companies in it. I haven't heard of any of them. The largest weighting of the companies is 2.6%, and it's a company called Daifuku Co. Limited, which is a Japanese logistics business, obviously doing it robotically. And the smallest company is Faro Technologies Inc., which is 1.56%. And so, as you can tell, there's quite a big spread. It's all robotics, 20 robotics companies around the world, a lot of them Japanese as I look through them. I think it's great. That's the sort of ETF that I'm in favour of. And really, I don't see it as an ETF. It's kind of, I see it as themed investing, you know, along the lines of the Motif investing business in the US, where they do pre-packaged theme portfolios, and also Macro View in Sydney, in Australia, which is with the Clay Carter, my friend Clay Carter's involved in. He's helping them construct these themed portfolios, and so these ETFs are exactly the same. And I think I do think they're a good way to invest in robotics. I mean, how are you going to know? But getting a little portfolio of 20 robotics businesses is a terrific way to go. I mean, as opposed to researching one or two and, you know, putting all your eggs in those baskets. I think it's you know, if you're interested in robotics, it's great. The problem, unfortunately, ETF Securities doesn't have many themed ETFs like that. I mean, maybe they'll do some more. I think it's a growth area, and there will be more. But so it'd be you know, it'd be great if there were more themed ETFs. But if you go to the ASX list of ETFs, or exchange traded products as they call them, on the ASX website, you'll see lots of particular ETFs and exchange traded products there, including this robo.axw is the code. Yeah, so you can look at lots of, there are a few like that. I mean, the ETFs that I'm against, or I don't like, are those that just go in the ASX 200, and you end up having half your money in big companies simply because they're big. Michael says, 1 week into my subscription and I'm loving TCI. Good for you, Michael. Thank you. We're loving having you. A question for you. I'm a master at buying shares, but a pauper at selling. I find I get swept up by the possibility of the next big announcement. What principles should I be using to guide the timing of my selling? Well, it depends what kind of investor you are, Michael. I mean, if you're a trader, then what you're looking for, what you have to have or know about, is the momentum of the company. I mean, is the momentum going well, or is it going badly? This is if you're buying and selling frequently. And the way a lot of people find out about momentum is by charting the daily movement of the stock or the index against the moving average. And so when it crosses the moving average, that indicates that the momentum is either up or down, depending on which way it's crossing. So a lot of people use, say, a 100-day or 200-day moving average on the chart, and then they'll keep an eye on how the daily stock movement is going against that. And, you know, if the thing goes above the 200-day moving average, they'll buy, and if it goes below it, they'll sell. I mean, that's for a trader. If you're a long-term investor, which is what I think you should be, you know, we're not trying to serve traders with the constant investor. We're trying to come up with long-term good ideas for investing, as well as the macro environment. But if you're a long-term investor, well, the time to sell really, according to Warren Buffett, is never. Of course, that's wrong, or at least a bit too pure. You can't do that. But the time, in my view, to sell is when something changes, when you notice that something in the company has changed. Either they've made an acquisition that doesn't look like it's a good idea. I know it's hard to tell sometimes, but When Slater and Gordon made that big acquisition in the UK, it did not look like a good idea, and that was correct. When something in the environment changes, like online shopping comes in, what do you do about Myers? The answer is that's something that's changed. That makes Myer, in my view, a sell, or it did make Myer a sell. Amazon's coming. I reckon that makes other retailers a sell in Australia. So things changing, or a change in management, which is disruptive. So look, I mean, if you buy a company, if you look at a company, you like it and you buy it, then and nothing changes, then in my view, you don't sell. You just stick with it, because, as I've often said, the only way to get a 10-bagger, that is to say a stock that goes up 10 times, is to not sell a 5-bagger. I mean, it sounds obvious, but I mean, quite often people go, oh, look, I've doubled my money. I'm out. I've done fine. I'm happy. That's it. But quite often, if you do that, if you sell a stock that's doubled, you've missed out on 10 times because that's just the beginning. And if you sell the stock that's doubled, what are you going to do with your money? You have to go and find something else. And here's a company that's looking great. So look, that's what I reckon. If you want to keep asking, write in, Michael. If you want to ask further, I'm happy to engage with you or anyone else on the subject of buying and selling, if you want to take it further. Ted says, really enjoyed the interview with Nick Griffin. He's the founder of Munro Partners, the specialist technology investment firm. Nick spoke about identifying companies with lots of compute, semiconductor companies, and lots of data, Google and Facebook. These all seem to be offshore investments. What about companies that store the data? Are there local companies that could get swept up in the data AI boom? There's an Australian data warehouse called NextDC that could be worth a chat. Okay, I'll look into that. I think that's a good idea, Ted. I haven't had time really to do it before this live stream, so I'll have to get back to you on that. But I think you're right. There is something in that. I would say, just going back to what I was talking about before with the ASX's strategy for attracting foreign companies, there are quite a few technology companies now being listed on the ASX that you can invest in using Australian dollars, which it means that, in some ways you can start to treat these companies as if they're Australian. Like, it doesn't matter where they're located. The key difference between investing in international markets and Australian markets and Australian companies is whether you're taking currency risk or not. And if you're not taking currency risk, well, it doesn't matter where the company's located, it seems to me. So I think this is a really interesting development for Australia to have the ASX to have a lot of foreign listed companies here, particularly technology ones, that you can invest in without taking currency risk, and basically it starts to make our portfolios borderless, and it starts to mean that I think that you don't really have to have an asset allocation to domestic and another asset allocation to international. It just no longer is necessary. That doesn't necessarily mean you get out of your platinum and your Magellan allocations entirely, but you don't have to go through that because you can develop your own portfolio of foreign companies on the ASX. So yeah. Tim says, perhaps this is an ignorant question, but if the main game, so to speak, is blockchain and its ability to eradicate counterfeiting, what is stopping the government authorities from adopting the technology for conventional currency? It seems to me a logical thing to do, and surely we would all have more confidence in a regulated official currency than some made-up cryptocurrency. I struggle to appreciate that consumers can have ongoing faith in a non-official currency than can be regulated out of existence if the relevant governments collectively decide to do so. Any thoughts, Alan? This is a thinking out loud question as I lie on a beach in Thailand, so please forgive me if I'm missing anything or everything. Well, half your luck, Tim. And it was far from an ignorant question. It's a really smart question. And the answer is many governments, including Australia, well, it's the central bank really, the Reserve Bank, are investigating using blockchain for existing currencies. That is a live issue, live discussion point for many countries, and it is felt that it's likely to be able to happen. So I have actually reported on this and reported that that is happening. And there is actually a project going on in Australia that includes Treasury and the Reserve Bank and a few blockchain experts in Sydney who are having workshops specifically designed to look at using blockchain for the Australian dollar, which, you're right, is a good thing to do because cryptocurrencies, even Bitcoin, which is large and quite well established, could be regulated out of existence, essentially, by governments saying we don't want it to happen now. And I actually think that's very likely to happen. I mean, we saw it with China. They haven't actually banned Bitcoins, but they've kind of restricted trading on them, and they are clearly against it. And I think part of the reason for that probably is that they have in their mind that the renminbi will be on a blockchain as well. So I think it's interesting, and I think you're right, Tim, and it's not a stupid question. It's a very perspicacious question, if I may say. Christopher says, I'd be interested to hear your take on the upcoming Commonwealth Games, the state of infrastructure investment, Gold Coast property prices, and whether these major events are really a boom for the economy. I don't really know, to be honest, Christopher. I mean, you often see Olympic Games and Commonwealth Games and all that stuff leading to a boom in spending in the lead up to it. Obviously, they're building all the stadiums and the accommodation for the athletes, which clearly provides plenty of work for people who work for builders and so on. That's obviously going to happen in the Gold Coast. I don't quite know how much has to be built, how much they've got already, but I presume they haven't got everything. And then what happens afterwards is that they all stand empty after the games are finished because they built too much, and that's it. So I just don't know. I'll have a look into it. I think it's not a bad. It's an interesting idea. Maybe there's some listed investments who will that will participate in this and maybe make some money, and we can identify them. So thanks for the idea, Christopher. I can't really answer it satisfactorily at the moment, but I'll check it out. Roger says, successive governments have directly and indirectly subsidised the fossil fuel industry since its inception. Could you examine those subsidies and give some thought to what a similar level of support to renewables would do for electricity prices? Or maybe, I mean, look, it's not really my mandate here doing this sort of thing. I'm a bit too busy finding good investments for people, Roger. So I'll see what I can do, but I'm doubtful. I mean, maybe there's. I tell you what, maybe my friends at Grattan Institute know about this, so I'll get him on. Tony Wood might know about this. He does this for a living. That's not what I do for a living. I'll get Tony Wood on, perhaps next week, and ask him. How about that? And Roger, if you wanted to send some questions into hello@theconstantinvestor.com, I'll make sure those questions are put to Tony, and I'm sure he will be only too happy to answer them. Mark says, what do you think of the Rich Dad, Poor Dad author's current view of too much money printing from nothing, i.e. lack of gold standard, exacerbated by escalating debt since the GFC, reducing its value and eventually leading to massive and rampant inflation, as well as his collapse of the US petrodollar theory? He predicts from this an economic collapse in the next few years much larger and more problematic than the GFC. To be honest, I haven't seen that. This guy's name is, what's his name again? Robert Kiyosaki, who wrote Rich Dad, Poor Dad, very big selling book, terrific book. I haven't read it, but I'm told that it's great. See, the thing is that there have been predictions of rampant inflation resulting from quantitative easing for 10 years now, or 8 years at least, and it hasn't happened. In fact, inflation's going nowhere. Now, maybe eventually there will be, but I think the rules have changed. It isn't the same anymore, and it isn't the case that that money printing to the extent that's been going on causes inflation. And it is interesting to speculate why that is. It's certainly the case, in my view, and I've written this in Constant Investor, that Milton Friedman's view expressed that inflation is everywhere and always a monetary phenomenon isn't really true. I mean, the idea that printing money leads to inflation comes from that proposition. And I think we're kind of at the point now where we'd have to say that's not really true anymore. I mean, inflation, there has been the most amazing amount of money printed, not just in America, where they've got a $4.5 trillion balance sheet now, but in Japan and Europe as well. Colossal amounts of money printing, especially Japan. But they cannot get inflation off the floor. So there's no real evidence that it's correct. So look, the forecasters, predictors of rampant inflation as a result of quantitative easing, will probably not give up on it. And, who knows, maybe one day they'll be they'll be correct, but I doubt it. I mean, inflation is clearly low now because, to a large extent, because of technology, which is displacing workers, leading to low wage growth, and also bringing prices down on top of globalisation. So we had a period of globalisation which drove down labour prices, labour wages around the world, as all the Chinese people came onto the market, and then we've had robotics and now artificial intelligence, and I just think those things have completely offset the growth in money supply everywhere. So look, obviously we had the Fed last night saying that it's now going to start winding back quantitative easing. I was on about that last Saturday in the overview. You might remember it was an item entitled "Breaking Glass," which was referring to the business of whipping the tablecloth out from under crystal, table set for crystal, which is what the Federal Reserve is now trying to do, and it's trying to do it slowly, and so nobody will notice. And what I was postulating was maybe, as with tablecloths, doing it slowly leads to breaking glass, whereas you have to do it fast. But anyway, they're going to do it so that nobody notices. That's the plan, to reduce their $4.5 trillion balance sheet so slowly that nobody will notice. And all I can say to that is good luck to them. I hope it works. If you're interested, I mean, I had a half hour on the phone this morning with Jared Minack, the fabulous Tiger fan who is coming to Melbourne on Saturday for the big match Saturday night. Anyway, Jared gets into this topic and also the Australian economy and what's going on with property and so on. So that'll be an interview. It'll be up on the site tonight with the transcript with Jared Minack, but well worth listening to. He's always worth listening to, and one of the reasons for that is because he is not only perspicacious, as I say in the interview, but he also admits when he's wrong, and he gets it wrong like everybody does, and he admits it and talks about why he got it wrong and what he's learnt from that. And I think it's really very fine quality. Probably comes from the fact that he's a Tiger supporter and has had so many decades of heartbreak, and he's used to, as all Tigers supporters, Richmond supporters has become used to being humble That's what being a Richmond supporter teaches you: humility. Soros, Mark says, Mark goes on, okay, Soros has been concerned about a similar crash for years, and many years ago, Kerr Nielsen thought US debt was unsustainable and would lead to tears. Should we be cashing up and getting debt-free or buying already overinflated but inflation-proof housing property to position ourselves for this possibility? Okay, well, so debt's another matter. I mean, I'm with you in being concerned about the debt, particularly in Australia. I think that the amount of debt in Australia, personal debt, household debt, has made the Australian economy quite vulnerable. And I think that as interest rates rise next year, as they will, that will lead probably to a sharper cut in consumer spending than would normally happen because everyone's so geared. So I think that is an issue. Should you be cashed up? I often think these sort of things are to do with your own frame of mind. It's very, the question of whether you should go cash or not is not a question for advisors to tell you. It's really a matter for you because it's your money and you have to sleep at night. I could tell you what I'm doing, which is that, I'm not that cashed up, to be honest. But the thing is, my own investments, I like the companies I've invested in. I think that they're likely to be good companies for a long time. I don't invest in the market or in companies. I don't invest in equities as an asset class, and so therefore I don't kind of buy equities and then sell equities and all that stuff. I just kind of look at companies and try to think about what are the companies I'm investing in, do I like them, how are they going to survive any recession, that sort of thing. So look, if you're a kind of a big picture investor, the question of whether you should be in equities or cash is a relevant one. I get that, but the trouble is, there are as many opinions about that sort of thing, in terms of whether we're going to have a crash or something, as there are people in the world, to be honest. So you've got to make your own mind up, and you've got to feel comfortable with where you're at. I mean, there's a friend of mine who I won't name, and he kind of is a really nervous Nelly, and he's a smart guy. He's a financial journalist. He's in the markets all the time, but he's so perpetually nervous that he is basically entirely cash all the time, and he's missed huge rallies in the market. Like he's kind of sitting on 2 or 3% yields on his money, missing kind of 10%, 15% runs on the market, but he's happy about it. It's fine. That's the way he wants to be, and so it's just kind of a personal thing. I mean, I think he's crazy, but there you go. To each their own. Scott says, I had 2 questions following on from last week's live stream, which is a brilliant initiative, by the way. No worries, Scott, thank you. 1, you mentioned that you'll try and interview lithium mining CEOs in the near future. Could you please interview Martin Donoghue from Kidman Resources? I'm very interested in their joint venture refinery with SQM. Okay, will do. He's on the list, forthwith. Got that, Greg?
Yep, copy that.
Copy that, he says. And the other person I need to get back to soon is Sam Riggle of Clean Tech. There's been a lot going on. I've interviewed him once, I think, or twice. Anyway, really interesting company, Clean Tech, cobalt and nickel. Cobalt's the thing. So I'll get Sam back on too. And who else is there? Lithium miners. Yeah, all right. Anyway, I'll find a list and we'll get onto it. Number 2, you mentioned that the best way to invest if starting out at 20 would be to put your money with 5 fund managers who can achieve 15 to 20% minimum and keep contributing over time. Yes. Could you please discuss how to locate these managers, particularly when a lot of good funds are closed to new investors or have high Golly, I'm just looking at our list of questions. It keeps growing. We could be here for a while. A lot of good questions. Anyway, so how we find funds that can do that? Well, look, I'm taking that as my job really. I've got to do it. I had an arrangement with Mercer where we were publishing their list of fund managers and the returns and performances, and it seems to have dried up. They're not giving it to us anymore, and I only found this out the other day. So I've got to chase them up to see what's going on. See the Mercer list. There is a problem with the funds being closed and the reason it's a problem is because the best funds are closed, or at least the best funds limit the amount of money they have, because the bigger you are, the more difficult it is to have a decent return. I mean, I'd go so far as to say it's virtually impossible. It is impossible to get a 20% per annum return in a large fund. You just can't do it because you can't invest in small enough companies, and it's only really small companies that provide you with those sort of returns. When you've got a big fund, you have to invest in liquid businesses where you don't move the stock price too much when you buy. I mean, if you've got a big fund and you're buying small companies, firstly, it's hard to get in because there's just not enough stock available, and secondly, you move the price when you buy or sell. So that's hard to do, and so it's only in a way, it's only the capped fund. So what I think we've got to do here is to identify funds that are going to be capped or are capped, but are still open that you can get into. We looked at one the other day, Ophir Asset Management. Now, so they're capped, but they've got a new fund that's opened. So they've got two funds, one is capped and one is open. And I think that's in a sense it's cheating a bit because they cap the fund and they fill that up, but they're still ambitious, they want to make more money, so they kind of start another fund and then another one and another one. But at least, I suppose, as long as they have different investment mandates or something, they can still invest in small companies. But yes, I'll try to do better than we've been doing, and we'll try to get the Mercer list at least, so that you can see who's got good performances according to that list. Chris says, are you still positive on Europe over the next 12 to 18 months? If so, how should we invest there? For example, do you like iShares Europe? Yes, I do. The ASX code is IEU. I think that is probably the best way to get broad exposure to Europe. I know I'm not in favour of ETFs in general, but I regard Europe as a sort of a thematic investment. And so there's that. The alternative really is to buy a couple of banks, because banks tend to be exposed to the entire European economy, and the ones that I would think about would be ING in the Netherlands and the one in Italy. What's it called? Banco something. Banco Popolare, I think that's it. But anyway, probably not Deutsche Bank. I think it's broke. But I think either the ETF or banks is the simple kind of way to go about it, in my view. Matthew says, question about Telstra and talk of it turning itself around as a tech company. Yes. Firstly, what would this mean, and importantly, does this mean they will move away from their core current business? I'm not sure what it means, to be honest. I think they're trying to figure out what it means. I think they are moving away from their current business, core current business, as you put it already. Well, it's been taken off them by the government. I mean, their core business was providing the network, running the Australian telephone network. That was the core business, and that's now been in the process of being taken off them, and they're being paid for losing it. In a sense, it's being nationalised by the NBN company, and they're being paid for it basically on an instalment plan. They then become an NBN reseller, like the whole lot of others, like 100, 200 others. But they're the biggest NBN reseller, and so far, you'd have to say so good on that. I mean, they are managing at this stage to hold their market share at around 55 to 60%, and I think there's no reason to think they might not actually continue that. But the trouble with it is it's much lower margin business. The reason that they were such a terrific business before, and they made more money than they're going to make in future, is that owning the network and selling the access to the network both as a phone company and a retail phone company and an ISP meant that they got a bigger margin, profit margin, and now reselling the NBN, even if they had the same amount of market share, which at the moment they do, the margin is much smaller and the profits are smaller. So, Andy Penn's said that that's going to cost them $3 billion a year in revenue. So they have to do something else, and what else but to be a tech company. As I've pointed out, they were going to be a tech company 10 years ago when they bought a technology company, a services business named Cas Group, which they promptly stuffed up and then sold for a fraction of what they paid. So they went into tech, stuffed it up, sold it, and now they're doing it again. And I think there's either today or tomorrow, it might be even today, there's a big presentation, day-long or two-day-long presentation called Vantage Telstra about what they're doing. And as you can tell, I'm not there. I haven't got time. I'll have to read about it later. So I don't quite know what they're doing in technology. I think the world's changed a bit. I think it's hard. I certainly think you can't be a technology company and pay 75% of your profits out in dividend, which is what they're doing. Even though they've cut the dividend, they're still going to be paying out 3/4 of their profits in dividends. So they'll be fighting Amazon and Microsoft and Apple with one arm tied behind their back, to be honest. Anyway, look, I'm pretty negative about Telstra. I wouldn't own it. I think they're going to struggle. Michael says, perhaps I've missed the point, but when you say investing in foreign companies listed on the ASX removes currency risk, isn't there still currency risk if their earnings are dominated in the foreign currency? That is true. You're just not taking personal currency risk. You're not having to buy the shekels or the US dollars yourself. But of course that's right. But there's currency risk embedded in virtually every company on the ASX. Not all of them, of course. There are some companies on the ASX that are entirely Australian dollar earnings, but BHP US dollar earnings almost entirely. So Boral, CSR, CSL, all these big companies have currency risk in them. Of course, that's correct. Translating them into the foreign currency within the company causes currency risk. I'm just talking about personal risk, where you have to buy the currency yourself to buy the shares. You don't have to, when they're listed here, you don't have to do that. You can buy the stock in Australian dollars. John, I see that CBA announced the sale of its troubled life insurance business to AIA Group for $3.8 billion. Is that indicative of a strategic change to its wealth business, or simply a capital raising technique to satisfy the regulators? Well, actually, the other thing they announced today, John, is that they're having what they call a strategic review of Colonial First State, which is the broader wealth management business. So they've flogged the life insurance, but they're also having a strategic review of the rest of the wealth management business, possibly leading to an IPO of it, separate listing. It is indeed indicative of a strategic change to its wealth business. They're going to get rid of it, which is interesting because that follows up what ANZ's been doing, and all the banks really. Essentially, the acquisition by these banks of these big these wealth businesses. So for CBA it was Colonial First State, for Westpac it was BT, for ANZ it was ING, and for NAB it was MLC. So but none of it worked. They thought what they could do, the whole plan was that they would sell more products to their bank customers. You know, the tellers would become salespeople. You'd walk into the bank, and you'd get flogged super as well. That was the plan anyway, and it didn't work. Partly because no one goes to the bank anymore. Everyone just does their banking online, and so the idea of selling people other products kind of doesn't work because everyone's online, and also nobody likes banks. They don't want to use banks for their super. They want to use super funds. And the bank-owned super funds, all of them, have not performed very well. Just the way it is. Retail, that is to say bank-owned super funds, have performed worse than industry funds. And so they've deservedly fallen by the wayside, and there you go. But they might also be trying to raise capital to satisfy the regulators as well, John. I'm sure that's probably right, but I think they're already there on capital, to be honest. I think they didn't need to do that. They just wanted to get out of life insurance because it was a pain in the neck. And they don't get it, and they don't want it anymore. Yes, CBA has a lot of work to do in general. So that was the last question, and it's been a good, solid session today. So thanks for joining me. It's really been enjoyable. Remember, the live stream may not be appropriate to you, and definitely it's not personal advice. Today's interviews are, I mentioned Gerard Minack. He'll be up on the site a bit later. And also Simon Hackett, who's the CEO and largest investor in Redflow, the battery business. And those shares have gone from 50 cents to 10 cents, so it hasn't been a great time for either Simon or anyone else. But he's terribly upbeat, and convincingly so, I may add. Of course, all CEOs are convincingly upbeat, every single one of them, as you would have learnt if you'd been listening to my CEO interviews. I've actually known Simon Hackett for many, many years, and because when he was running Internode, he owned Internode, which he sold to IINet for an absolute shirtload of money, some of which he's put into Redflow batteries. So there you go. And also today is Percy Allen's fortnightly contribution, which I haven't read yet, but I'm sure it's as wise as it is usually wise. Thanks for your company today. I'll see you next week.